I'm Cynthia Rowland, and this is episode 119 of EO Radio Show. In today's episode, I talk again with Dale Schroeder and Anneke Niemira at NewEdge Wealth. Our topic is charitable remainder trusts today. Last week, we talked about charitable lead trusts and split interest trusts in general. In today's episode, Dale, Anneke, and I take a deep dive into the world of charitable remainder trusts and their technical issues and traps for the unwary. Welcome to the EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Farella, Braun & Martel. My name is Cynthia Rowland, and I'm a partner at Farella. I'm a business and tax lawyer with more than 30 years of experience advising clients on nonprofit and charity law. Through this podcast, our lawyers and guests will discuss a range of legal and business issues impacting the nonprofit world because we understand you work hard every day to make your community a better place to live and do business. Many of our programs focus on the basics, and at times we'll do a deep dive into narrow and complicated legal issues. Again, welcome to the EO Radio Show. We're glad you're here. I'm delighted today to be joined again by two experts from NewEdge Wealth, Dale Schroeder and Anneke Niemira. As a managing director of NewEdge Wealth, Dale advises ultra-high net worth individuals, alternative investment managers, family offices, and institutions with fixed income and equity investment strategies. With nearly 30 years of experience in the capital markets, Dale's expertise lies in risk-reward analysis as well as retirement, legacy, and philanthropic planning. Anneke helps clients design solutions and strategies, guiding families through the complexities of multi-generational wealth. This includes addressing all facets of multi-generational wealth, including estate planning, wealth transfer planning, financial planning, philanthropy, tax planning, risk management, and next-generation education, among other areas. So in today's episode, our focus is on charitable remainder trusts, and I'm delighted that Dale and Anneke are with me again today. Hello. Nice to see you again.
Hello.
It's great to be back. Thank you.
In a previous episode, we talked about charitable lead trusts and the variations of those. Today, our focus is on charitable remainder trusts, and there are many more acronyms that we can toss around today. So, Anneke, introduce our listeners to the concept of charitable remainder trusts and what they look like.
Absolutely. Thanks, Cynthia. So a charitable remainder trust is the other type of split interest irrevocable trust. So as we learned about last time, a split interest trust has a combination of a charitable beneficiary and individual beneficiaries, or a trust for individuals. And so here it is the reverse of a charitable lead trust. This is where usually the grantor, the trust creator, and or their spouse are beneficiaries up front of a trust for their benefit for a term of years, often a term of years or lifetime. And then the remainder, again, the opposite from a charitable lead trust, the remainder goes to charitable beneficiaries. So upfront to grantor, term of years, and then remainder to charitable beneficiaries.
So are there any variations in the pattern? I guess this is the point at which it might be early, but maybe there's more you need to explain. But the difference between a CRAT and a CRUT and a NICRET or NIMCRET or FLIPCRET, all these different, blah, blah, blah. Define our acronyms for us.
Absolutely. As we noted last time, the annuity trusts are ones where you have a fixed dollar amount. Either it's a percentage of the original starting value or it's just a fixed dollar amount mentioned. So that's the annuity trust for the annual payment. And then you could also have the unitrust method. So that would be the CRUT. And that's where you have the percentage applied to the value as it changes annually. So you will have a variable annuity year over year. And unlike the charitable lead trusts where we saw CLATs more often than CLUTs, in the CRTs, the charitable remainder trusts, it's the opposite. We see CRUTs more often than CRATs. We do have many, many subtypes, as you noted, Cynthia, of, NICRET, NIMCRET, FLIPCRET for different subtypes. And since CRUTs are more common, we do have these different subtypes. And the reason we have different subtypes is that the donor might want to have more control over the income structure coming out to themselves. And there might be extenuating circumstances, shall we say, where you might want to use certain ones. We see them very often. These subtypes might be used, especially where you might have a business or some sort of illiquid asset that ended up in a particular CRUT. And so you might want to use one of these other subtypes in order to fit your own fact pattern. For example, let's say you have a business, and FYI, you generally don't want businesses in there unless it's often a C corporation because of this icky thing called UBTI, where there's a huge 100% penalty if you have unrelated business income in your CRUTs. I'm jumping ahead a bit, but just FYI, there is that little nitty gritty detail which can blow things up. So don't mess that up. But let's say you have a C corporation business in your CRUT and you expect to sell, say, in the next year or two on funding, and the CRUT is supposed to send out income to the beneficiary. But there isn't any income because you're holding it all in your hot little hand, i.e. the C Corp in there isn't distributing anything out to the underlying trust from the corporate entity. So because of that, you might want to pick one of these subtypes of CRUTs so that it will, let's say you have a couple of years where there's no income. You might have a NIM CRUT, which is a net income with makeup CRUT, where you would say, okay, if there were previous years of underpayment of income, you have essentially a catch-up provision where, not to be confused with like the ketchup you get in McDonald's, but a catching up of prior income where you say, okay, let's say I was supposed to send out 5 or 6% of income, but I couldn't because there weren't none, as it were. You go back and you do additional income beyond the expected income for that year to make up for, again, that's the NIM CRUT, the income that didn't happen earlier. The NI CRUT or NI CRUT, I guess I don't want to say it, but the NI CRUT, the NI net income CRUT pays all net income. So it's not saying, okay, it's a specific percentage, say 5 or 6%. It's just saying pay the income, but it might have a cap where it's saying, okay, you can pay this much, but not more than, or whichever happens to be the difference. So that is also common. We already talked about the NIM CRUT. And then you have the flip CRUT. So this is where there is a triggering event where you have some sort of item, or it can't be something like when the grantor decides to, because that's not a triggering event. That's just a arbitrary decision by one particular person. But it can be something like when my first grandchild is born, when so-and-so gets married or divorced. Or more often it is, again, that same business transaction. You might say the flip CRUT, and the reason it's called flip is that it flips from one type of CRUT to another type of CRUT when this triggering event happens. So say it's the business sale, you might start out and say it's type 1, and then you flip at the triggering event to a different type of CRUT that works better once the triggering event has happened, like once there's liquidity in there because the business sold. So those subtypes work really well. And again, it's very specific to the fact pattern. So it gives us a lot of flexibility in planning.
And a lot of that's driven very early on by the investment advisor's ability to work closely with the kinds of assets that are in the trust, right, Dale? I mean, if you see your investment strategy as the manager might be very different depending on which type of trust you have and what the income expectations are.
Exactly. I think it's a great place to highlight how important it is to really dig in with a lot of questions so that you understand what the goals and objectives in the situation is with every individual before you sit down and open up the toolbox and say, look at all the cool toys we have. Right? Yeah. Because there are certainly a lot of options.
There are. And there are a lot of traps for the unwary. I feel like the lead trust conversation is a little bit simpler, where the remainder trust, there's so much flexibility, and there's also a lot of traps for the unwary. You mentioned the UBIT trap. There's other things that can go sideways. And as we get into that and really thinking about the decisions that need to be made, we've thrown a whole bunch of tools onto the table here. How do we start narrowing down? Suppose we have a donor who's sophisticated enough to really understand the choices they're making, and there's sufficient money at stake to really try to maximize the opportunity. What kinds of decisions does the donor need to make early on? Once they're a candidate, we know they've got an asset that's right for this. Can you walk us through some of the decisions? I don't know which of the two of you wants to start off on that. I know there's a lot of decisions.
Sure. There are a lot of structural rules on CRTs, as you were noting, Cynthia, that aren't necessarily applicable. And you're right. CLTs, you have the big decision of, is it a grantor trust or not? Do I take the deduction or not? But other than that, it's relatively similar. But on the CRTs, the charitable remainder trust, you do have a lot more decisions to make. Obviously, you can pick a term of years. So are you doing it for a particular period of years? And the CRTs do have a rule that the maximum term of years is 20 years. You can do it for someone's lifetime or more than one person, and where the lifetime is estimated to be greater than 20. But if you are doing it by years, it does have a limit of 20, unlike the CLTs. So maximum duration. And sometimes you'll say, what am I trying to achieve? Right? And the longer the term, there's a benefit to structuring it based on the duration, because you're trying to say, how much am I going to get every year when I'm creating this, and how much is being left to the charity? And that is very much dependent on market return, but also very dependent on duration. Similarly, I get a lot of questions around, oh no, what if I create a 20-year CRT and I kick it? I turn up and I shuffle off this mortal coil and I'm gone. And suddenly in year 2, I should have gotten it for 20 years and all of the remainder goes to charity because I died early. I get that question a lot. That's where we see, I often use the phrase, if you're abducted by aliens, because it's not being hit by a bus, because I had a prospect who got hit by a bus once and don't ever want to use that phrase again. So,
it's a tough, it happens.
It happens. So, if they shuffle up this mortal coil after 2 years, yes, if they're the only person there, there's a potential that the charity would indeed get all of the money early. And so what you may see is that often the surviving spouse, if they are married, will be listed as that backup beneficiary. So it's for both of their lifetimes, or at least the 20-year period, the spouse gets the rest of the 20-year term, or you might have it go to your child, something like that. So you can structure it so that there is another person there. The amount going to beneficiaries annually, that is very formulaically driven, often using that same number cruncher tool that we spoke about on the last session, that you can have it must be at least 5% going out per year, but it can't be more than 50%. So you're not going to have, a 1-year CRUT, for example. And then you super important rule, must have at least 10% of the remainder going to charity. So unlike the CLTs, not only can you never, ever, ever zero it out, meaning you can never, ever structure it to get a 100% income tax deduction. And logically that makes sense, right? If you're giving away a bunch of it to yourself, how can you possibly structure it to say that it's all really going to charity? It's not. So most people structure it to have only that minimum 10% going to charity, because it's often not primarily a charitably oriented goal of why people do these CRTs. It's often a CRT is being done for the income stream back and income tax deferral. Less income tax avoidance, but income tax deferral is a huge, huge, huge motivator for these trusts, especially around diversifying low basis stock or highly concentrated positions in investments, where you just have too much of a good thing and you have all your eggs in one basket, and you want to, as I think you said at the very beginning, Cynthia, like you want to potentially, or maybe in the last session, sell something and diversify your assets. This CRT structure is fantastic for that.
I don't want to get too terribly geeky because it's hard to talk about in enough detail to make it really clear, but there are tiers of income. So in the CLT, the income was going out to the charity. In the CRT, the income's coming out to the individual. The individual gets a K-1 from the trust each year and has taxable income to report. But there's tiers of it because not all cash correlates to income. Can you talk a little bit about how that tier structure works and how, in the context, let's say, of this highly appreciated stock, what that means to the actual donors? Suppose they put $1 million in, they're getting $10,000 out. That's probably not the right number. But of the $10,000 they're getting each year, some of that's going to be taxable income, right? And then whether it's ordinary or capital gain depends on where you are in that structure.
Absolutely right.
Did I oversimplify?
No. So that was good. So the CRTs are sort of a special beast in they are an irrevocable trust, and irrevocable trusts have their own funky tax methods, but think of it as 4 separate tiers. In fact, it's referred to that as 4-tier taxation for the CRT taxation. And also perhaps think of it as least favored nation status first, meaning the worst stuff comes out to the grantor first. So using the example that you did, let's say you put in, $1 million or $2 million in our hypothetical to both address the idea of the client or grantor is also doing this for diversification of assets. So you can put in $2 million worth of stuff. and let's call it a huge concentration with very low basis, and you sell 100% of that $2 million stuff on the second day of the trust. You just totally hose it, wipe it out, sell it, and reinvest it in a more diversified portfolio so that you don't have this huge concentration risk. The benefit to the CRT is that it's not going to hit the grantor with all of those capital gains. Let's say 1.5 million of that was capital gain with $500,000 of basis. So you have 1.5 million of capital gain, but it's stuck at the trust level. It's frozen. It's like you stuck it in the freezer. It's frozen temporarily. And if the grantor has, say, $100,000 payment coming out to themselves every year, as you're noting, some portion of that 100, frankly, all of it is going to be taxable in those first several years, but it comes out in these 4 tiers. And this is how it comes out. The first tier coming out is that worst stuff, ordinary income, the things with the top tax brackets. Ordinary income shoves out first. It's almost like, you're mixing oil and water and one rises to the top and one sinks to the bottom. The stuff that's coming out first, it's divided into these layers based on viscosity, and the ordinary income and qualified dividends come out first in your first tier. So if you had, 60,000 of the 100,000 that's coming out in year one might be ordinary income because you got this big $200 million portfolio, $2 million, pardon my speaking. If you have this big $2 million portfolio, 60 grand comes out as ordinary income. And then once all the ordinary income is used up, then it looks to tier 2, which is capital gains. Well, you have this whole 1.5 million of capital gains. So the next 40,000 of your 100 grand for the year comes out 40,000 of capital gains. And now you still have almost the whole 1.5 million of capital gains left, but it does not get taxed yet. And that is the beauty of the CRT, is that you've stuck those gains in the freezer, and then you pay the next 100 grand of them in year 2 and the next 100 grand of them in year 3 and so on and so forth. It's that tax deferral that's what the CRT is getting you, while you can diversify immediately.
That's really well said. The caveat I'll put on that is it's not really in the freezer. It's in Dale's control, because our investment advisor.
I was going to say, we're investing. The good thing is we're investing those assets along the way. And while they're in the freezer, they're growing.
The gains are in the freezer, not the investments. The taxable gains are frozen and not yet taxed. Yes, good point.
Well put. So we don't have that big slug of income, taxable income. Dale is happy because he can invest it to meet all the goals. And I do want to mention, a lot of times these CRTs seem like a great idea, and a founder of a business is all hot to trot, except they don't actually want to fund it until they know they've got a sale. And so we have a big trap for the unwary, which is the assignment of income doctrine. You can't put our donor has their startup business. It's finally hit the big time. It's going to be sold to Google. They want to contribute it to a CRT the day before the sale closes. That's pretty tricky. So, check with your advisors on that. You covered 2 tiers of income. There's a couple more. If there's 4 tiers, talk about the rest of them.
Yes. So, and on that second tier capital gains, if you have collectibles or, whether it's short-term gain or long-term gain, yes, short-term comes out first, but it's all part of the second tier. But remember that some things like collectibles have a different tax rate and are counted as capital gains. The third tier is, quote, other income, way to be generic, but it basically means, for example, things like municipal bond income, things that aren't capital gains, aren't ordinary income. It's that other stuff that is still taxable in some way, or income. And then finally, if you've really gone through all the income over the term of the CRT, then it's return of principal. It's the underlying, basis, as it were, comes out. Most CRTs never really make it there because you always have some income generated every year, plus that deferred income tax burden. But that is the fourth one, is return of principal. So ordinary and qualified, capital gains, other, and then return of principal.
Fantastic. And then over our long-term life of this, we might flesh out the ordinary and the capital gain early on. And then through his investment magic, Dale keeps the investment returns low on the taxable scale. But there's a lot that can be done strategically to right-size the taxable amount of the distribution during the lifetime term of the payments. So what else should we talk about? There's some other unique features using IRAs and other fancy forms of trusts. Either one of you want to remark a little bit on super duper supercharging strategies? I think they are.
I think the one I like best perhaps is that CRTs with regaining stretch IRA treatment. Before our fancy Secure Act, both Secure Act 1 and Secure Act 2, but before the Secure Act, you could leave an IRA to someone and it could be for their benefit for their entire lifetime, even if they weren't necessarily the spouse of the original IRA holder. But the Secure Act changed that rule, and that with some exceptions, generally speaking, if a non-spouse is inheriting an IRA, you have to pay out the entire IRA by the end of the 10th full year after the person passed away. So we have now squished IRA payouts from lifetime, which could be multi-decades, to 10 years only. And that's made it so that people are now potentially paying higher taxes on those IRAs because it's coming out faster. So your taxable income is going up. But a CRT is a tool that you can use to regain that stretch IRA treatment. And the cost of kind of buying that CRT treatment or that stretch IRA treatment back is that 10% remainder to charity that you have to give anyway. So let's say you leave, how that works is you would leave your IRA to a CRT, and the IRA then, whether it's literally liquidated and distributed to the CRT or not, you have the IRA make its distributions out to the CRT, and the CRT could be for that beneficiary's entire lifetime. So you get that. And because IRA distributions are indeed taxed as ordinary income, which we know are tier 1, least favored nation status of that CRT, but that's fine because they get stuck at the trust level until they get distributed out to the beneficiary. So it really is annual payments of ordinary income to the trust beneficiary, just like they would have annual payments of ordinary income from the IRA, but you're allowed to use it over decades instead of 10 years. And that time value of money can really be helpful. It might well be worth the 10% you leave behind with the charity. And if you want to be ultra clever, this one last sentence here, you could buy yourself a life insurance policy or something like that to replace the 10% going to charity. So you're not fully leaving it behind. Charity gets it, but then there might still be that life insurance policy to replace the lost funds that go to charity. So it is a really neat tool. That income tax deferral is such a cool thing that if you have clients with large positions, especially now, right, with things like NVIDIA or other kind of famous stocks that have had really bang up results lately, you can really use this as a method of reducing your investment risk and diversifying right away for the low cost of, and you do get a deduction for that 10% remainder. I should have said that up front. But if you're leaving 10% to charity, you do get a deduction now for the future 10% remainder. So you're not completely losing a benefit.
Dale, any comments about the best assets to contribute? Let's go back. And we've talked a lot about what makes sense, but when you're working with a client, if you see particular types of assets, which ones jump out at you? Like, this would be a great opportunity for a remainder trust. And then a little bit about investment strategies when you're thinking about the whole portfolio.
So the first thought that comes to my mind is capacity, right? Yeah. These are irrevocable gifts. Can you afford to give it away? Granted, you will receive some or much of the cash of it back over the years through cash flow, but can you afford the gift? The second thing I would look at is, are there exceptionally low cost basis assets where you can really take advantage of that? Anneke referred to the putting it in the freezer, right? And letting those assets grow without the tax consequence for a longer period of time other than just selling the asset outright while it's in your estate. So capacity and low cost basis are probably the two primary things. As far as the assets allocation, once the trust is set up and funded with a low cost basis asset, it really depends on the structure of the trust, right? Much like the charitable lead trust, there's an incredible amount of flexibility in a charitable remainder trust. There are some barriers in place, but they're pretty wide, right? The barriers being, it can't be more than 20 years. You have to take at least 5% out of the trust on an annual basis in terms of cash flow back to you. And you have to leave at least 10% at the end of the trust for the benefit of the charity. But those are really wide guardrails. So depending on what the goal of the grantor is, the asset allocation certainly is very important, right? If it's, hey, I want to take a really low distribution myself, maybe 5%, I'm more concerned with leaving a larger amount to charity. That tells me then there's less need for cash flow. Maybe the time horizon extends out. Volatility matters less. I can take more equity exposure versus somebody that says, oh, the cash flow is super important to me, especially in the short term. I need 15% back to me, right? That tells me liquidity is more important. We need to minimize volatility. Maybe a portfolio with a stronger allocation to fixed income or a less volatile asset makes sense in that case. So it really depends, but lots of flexibility.
Absolutely. And I did want to mention, I don't want to go down these rabbit holes, and maybe I'll just refer the listeners back to episodes on private foundations, but these split interest trusts are treated for some of the excise tax rules as private foundations. And so there are steep penalties for insider transactions. And so I just want to put a footnote in here that these are strategies where you use a professional investment advisor that's using investment strategies that are not involving the donor or the donor's family business. I don't think it happens as often now, but 30 years ago, there were more people playing around with remainder trusts and lead trusts and investing in their own businesses. But there are self-dealing rules that can be traps. And we talked a little bit about the UBIT trap. Maybe it's more obvious to people not to borrow money inside a trust, but sometimes investments in private equity funds that have debt financed investments within them can trigger a UBIT on your K1. I think that's more or less fatal. I mean, that's a really serious flaw. Have either of you seen that come up in somebody else's plan, not your own, I'm sure?
Only stories of it.
Yeah. I agree with you, Cynthia.
Enough to know that you have to be careful.
Yeah. I agree with you. I think I was going to circle back with the UBTI as well, and I'm glad that you did. I think that's exactly right, that not only do you have to be very careful of the business structure if you are attempting to have a business in there, however temporarily, and that just FYI, CRTs are never, eligible C Corp shareholders. So don't try to put your C corporation in there.
S Corp.
S Corp. I'm sorry. You're right. I was looking at my note and saw S Corp and said C Corp. So C Corps are okay. S Corps are not okay. And it will break your S Corp altogether. So please don't do that. But yes, C Corps are very, very valid. And as we previously discussed, and just being careful on that debt financing and having debt, as Cynthia mentioned, can also be the kiss of death. So be super careful what you're putting in there and what you're doing, especially if it's debt structured in that regard as well. And then that final note, I have heard of some people working on putting businesses anticipated to sell that are eligible for Section 1202 QSBS benefits, where you can exclude up to $10 million or 10 times basis of capital gain tax or income rather. And so you can put a business in the CRT and possibly get QSBS treatment on that business within it. So you kind of get a double benefit for income tax purposes. I have seen that more recently as well.
Interesting. That's a very cool idea.
Yeah, it's a neat, double win.
Yeah. I think that covers everything, unless either of you have some final parting thoughts on our fun split interest trust topic. It's been a lot of fun to talk about it with the two of you. I've really appreciated it.
Same. This was really fun. Thanks for having us.
Yeah, thank you. It's really enjoyable. Great experience. Thank you, Cynthia.
All right. Well, I hope the listeners have enjoyed this. Thank you both. So that's all for this episode. Be sure to check out the show notes for links to more resources and for organized playlists on this and other related charitable topics. We have links to our Forella YouTube channel, and that includes all of our charity resources in convenient playlists. I'm Cynthia Rowland, and you've been listening to EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Forella, Braun & Martel. If you have suggestions for topics you would like for us to discuss, please email us at eoradioshow@fbm.com. That's eoradioshow@fbm.com. Thank you for joining us. Until next time, make a difference.